Hello everyone to the last day's financial development growth and financial cycle session. Today we are planning to have three distinguished speakers, and we can go like paper by paper. We can present the first paper, then we can discuss about it, and then we can move to the second paper. It will be, I think, so more fruitful. So our first presenter is our first presenter is Kazi. He is going to talk about the oil shocks and financial stability in MENA countries. You can think of like 15 or 20 minutes, okay? Thank you.
All right. Should I stand here? Okay, can I start? It's my pleasure to be with you. Today I'm going to present a co-author paper entitled Oil Shocks and Financial Stability in MENA countries. So my co-authors, Ahmed, Elsayed from Arem University, me from Russia Ural Federal University, and Ricardo. So I designed my presentations. I will talk about the background and motivations, and theoretical underpinning, data method, result discussion, and concluding remarks. So the background, I would like to go back a little bit the history, how oil and financial markets are connected. So I'm sure that all of you know that after the Second World War, when Bretton Woods policy took place, so the Federal Reserve System still continued a gold standard. So it was like 1 ounce of gold was redeemable with $35, and rest of the currency will be pegged with USD. So the reserve currency is a USD, and USD will be pegged with the gold, and rest of the currency will be pegged with USD. So meaning that it will show some integrity of money, since the money will not be issued out of nothing. So the high-powered money times velocity should represent the GDP or the overall economy. But after 20 years of this gold standard, so USA basically they printed enormous amount of dollars. So when the France government asked Federal Reserve System to give this amount of gold, they failed to do it. So then there was a questions about the integrity of money. And the same times, there was a Arab-Israel war started. So King Faisal, when he put oil embargo, then Henry Kissinger visited, and eventually Arab leader convinced to sell oil in exchange of dollar. So the dollar became the medium of exchange of all oil traded around the world. So that created an enormous demand for the dollar. So in that time, the Nixon abolished the gold standard and introduced the petrodollar concept, meaning that Federal Reserve System can print dollar backed with proven reserve oil. So from that time, oil and dollar, the rest of the currency, is highly anchored. So any shocks in oil market that gives significant implications in the financial market, because if you can see from 1970 when oil embargo started, the oil price increased from $4 to $12. So immediately globally there was a hyperinflation. So there was a financial stress, right? At the same time, so when oil price plunged in 2014 due to the fracking boom in United States, so many oil exporting countries that suffered. So there was a question about the fiscal stability of this country. And same times it's happened in COVID, but in recent time when the war started with the Ukraine, so again the oil price gone up. So many countries, including Saudi Arabia, have highly benefited. So now we'll try to see that how it affects the financial stress. So financial stress is a very complex index that represent the overall the health of the finance of a country. So if you can see it coming from the spread of money market, zero coupon, short-term federal loan bonds, stock market volatility, financial industry stock price index, dispersion of return of assets of financial institute, spread of interbank rate to the bank rate of the central bank, exchange rate volatility, and inflation. So out of all this index, we created the financial stress or stability. And as for the oil market shock, we constructed from the three types of shocks, because since oil market follows like an oligopolistic market, so meaning that any prominent member, they have a power of changing price, like Saudi Arabia or Russia. You often see that price war between these countries. So when they come into the cooperation, like a recent move of the OPEC, they try to cut the oil price, oil production, so it will increase the oil price. So meaning that since the oligopolistic market, they have a power of changing price. So the demand shock and supply shock will be asymmetric effect on financial markets. So from this methods, we try to find out the three types of shocks. One is the risk shock. The risk shock is coming from the market volatility, that's the VIX. So it is the third equation. From third equation, we go to the second equation, when it was the return of the stock of major oil companies equals to demand shock and the risk shock. So here, demand shock is unknown and two unknown. So we can, from these two equations, we can find out the demand shock. Once the demand shock is identified, then we know the price changes equals to supply shock, demand shock, and risk shock. So this is how we try to decompose the three types of shocks. Then this is the data shock, shows the daily data. I think 5 days in a week, because Saturday and Sunday we didn't consider it since the stock market doesn't work. So it's a supply shocks, then one risk shocks and demand shock, the data shows. This is the channel we try to explain that how oil shock can penetrate or spill over the financial stress. One is the stock market. When there is a positive shocks, the increased production cost, then decrease in expected corporate profit, inflation pressure, and the stock price movement. Then exchange rate, when there is a positive shock, price shocks, demand shocks, supply shocks. One is the exchange rate appreciate or exchange rate depreciate. So that depends on whether the country is exporting country or importing country. So in MENA country, I cannot take all the country in one basket, because some countries are prominent exporter and some are not. So the budget deficits also, since oil revenue plays a very important role for the government revenue. For example, in Saudi Arabia, it's a highly dependent, while the UAE or Qatar, they reduce the dependency on these things. So fiscal stance also matters for the oil price shocks. So to see these shocks, my empirical setup is that all this MENA country, and including Turkey, I use a cross-quantilogram approach. This is kind of a new methods that can give the spillover effect from one shock to another shock under different quantile. And these methods also has some benefits with one shock to stationary series bivariate model. For example, if any shock take place today, so whether the market financial stress will respond today or not, so I can consider a different type of time horizon, that how long it will take to have a spillover effect from one market to another market. So these are the advantage, and another important advantage is that this data is a highly volatile. So there is a market bullish condition and bearish conditions when the price is very high, when the stress is very high. So it's a double quantile, conditional quantile. So it can capture the market normal condition, bullish condition, or bearish conditions. Also, I check the robustness check with the quantile coherence. So this is the findings for Bahrain. I will try to be very brief. So it is demand shock, daily memories, supply shock, daily memories, and risk shock. So we can see that demand shock, it has a asymmetric effect. So when the price is low for Bahrain, it has a negative shocks, meaning it reduces financial stress when the price is high. So it improves the financial stability. So most of the, in this diagram, this stars represents the significance and the different quantile of the two variables. So in supply shock also asymmetric effect, but the risk shock is mostly this financial stress is increased. And for the Egypt, oil shocks is less connected with the financial stress compared to other country. For the demand shock, it reduces financial stress. For Jordan, it also reduces financial stress from the demand shock. Supply shock, it increase, and the risk shock is no significant effect. About the Kuwait, the risk shock increase financial stress enormously. As for the demand shock, it reduce financial stress, also supply shock. So this is the case of Morocco. Also we see the asymmetric effect, and most of the effect is it takes place in the quarterly memories, 66 days. Since oil market, it takes time to sell and the money comes and the revenue, so there is a time lag. Regarding the Qatar, it shows that it reduces financial stress when there is a demand shock. Also Saudi Arabia, when demand shock is high, it reduces financial stress. But in the case of Saudi Arabia, it's a little bit different when supply shock or risk shock is less, because they still follow the monetary system like a pegged exchange rate. So their exchange rate is not devaluating or evaluating due to the financial shocks. They can absorb it. About the Tunisia, almost no significant effect. For Turkey, the demand shock is the financial stress from the demand shock is very quickly in 1 day. From the risk shock, you can see that it increased financial stress. As for Turkey, the shocks is very immediate. Within 1 day, it can create a shocks. So this is more volatile. As for the UAE, financial stress also increase in risk shock, also demand shock, and supply shock. This is kind of a robustness check. We can see market bearish condition, bullish condition, and normal condition with the quantile 95% and 50% and 5%. So it shows that this is the daily connectivity of this market. This connectivity increase in the yearly memories and monthly memories from this dotted line in the bullish conditions. So when stress and price is very high. So the conclusion is that we find the financial stress in particular acute during extreme oil price demand and supply shock, especially longer horizon, suggest a more gradual impact of oil price movement of the stability or instability of banking sector. So the suggestion is that since these two markets are very much connected, so there should be some kind of a macroeconomic prudentials that some of the country in MENA, they have some macro prudential, like in Saudi Arabia, they have a sovereign welfare fund, or they call it public investment fund, so that can absorb any kind of a risk. But some other countries, I don't know much about Egypt, whether they have macroprudential policies or not. As for Turkey, I think financial stress is very high. That's coming from the oil market. So apparently Turkish central bank policy is less effective than Saudi Arabia or UAE or Qatar. So I see the financial stress in Turkey is higher, so there should be some absorber or the driver to reduce these shocks. I think this paper is very general than specific, since we consider many countries individually. So that's all. If you have any question, I'm open for you. Thank you very much.
Okay, so thank you, Kazi. Before beginning to my discussion, I have to say that I'm studying applied macroeconomics. So this paper is far, far away from me, but I will do my best to discuss it, okay? So my comments will be limited. So in this respect, the comments from the audience is more than welcome, okay, to improve the paper. So let me begin by summarizing the findings. Okay, so it's a really well-written article on a very interesting topic, particularly for MENA countries, and the paper addresses the relationship between commodity prices, financial market shocks, and financial distress. It employs 11 countries, and it covers the period 2006 to 2021, and they report results country by country, and the main findings are maybe can be summarized in this way. By capturing different market conditions and different time horizons, authors find that financial stresses occurred during extreme oil demand and oil supply shocks, but particularly at a longer time horizon. However, when we look at the financial risk shocks, we see that it's more pronounced at relatively shorter time horizons, and it's regardless of the quartiles of distribution in generating financial stress. Okay, so my first comment, it's really super useful to provide the results country by country, so we can, in a way, understand the dynamics in the country, because these shocks are differently affecting those countries. But we know that there are some similarities between those countries, right? So we can just divide them into like being an oil exporter or importer, or like having a deep or shallow financial markets, and the degree of connectivity to world markets are also different. So maybe we can, in an additional part of this study, we can group those countries, okay, according to these subgroups, and we can run the analysis by these subgroups as well, and in this way, we can have an idea about these groups. So why it will be useful? Because the sample covers only 11 countries. So there are some countries left out of the sample. So in this way, if we can just, if the country is not belonging in the sample, but it's out of the sample, so we can have a general idea by looking at the group about these country dynamics, and we can propose some policies based on these findings. So it could be a useful exercise for the out-of-sample countries. The second thing, it is not apparent to me, but you know, during the time period that the study covers, there are two major global shocks. So 2008 and 9 global financial crisis, and we have the COVID-19 there. So I don't know how the methodology addresses these periods in this study. So it's not clear to me. Well, this study uses some quantiles, but they do not give any explanation. So why did they choose the quantiles? So it's also important because when you change the definition of the quantile, the results are changing. So at least as a robustness, you can just choose some other quantile levels and run the analysis, and maybe you can put it into appendix or something like this. And in an econometric framework, while investigating relationship between two variables, we want to control some other additional variables, right? At least for preventing omitting variable bias. So I don't know this methodology, but is it necessary to control for other factors that affect the coherence between financial stress and sources of shocks? Okay, so I don't know, is it important, but at least in econometry it is important, and otherwise you can just lead to spurious coherence estimates if you ignore it. My final comment, it's not given here, but while we were presenting, I thought it. So while creating the financial stress index, you simply taking the simple averages of exchange rate, the banking sector, and the stock market, right? You simply add them and divide it into two. But the share of these markets could be quite different within each country. For instance, in one country, banking sector could be so important, but in other one, it maybe has a small average. So based on this, while calculating the financial stress index, maybe you can use these counterweights to calculate this index more properly. Okay? So these are my comments. Now I would like to open the floor for Q&A session. Any questions? Comments, questions? Anyone? Sure.
So, my name is Ahmed. So I just, one question about the policy implications for the oil importing. And I just wonder, so the oil shocks mean that the price has went up and so on. So it's like, do you see a difference in sensitivity between the oil importing and oil exporting? So the reactions, I mean, the issue also you are focusing in 2 dimensions and not overall picture, right? So you should find a contrasting result between the oil exporting and oil importing ones, right? So also it was, for me, I was a bit slow to catch everything from the slides. But if you have something on policy implication.
Okay, Kazi, so you can answer.
Yes, this is what I said, that the impact is asymmetric. So for exporting country and importing country is different. So when while price is very high, exporting country, their currency will be appreciated, and importing country will be depreciated in general. But in some country, for example, Saudi Arabia follows pegged exchange rate. So meaning there is, in exchange rate, at least there is no effect. So about absorbing these shocks, there should be a macro prudential. So different country has a different policies. So as for me, as an expert of Russian economy, that is not here. But I also work on Saudi economy a lot. So financial, this absorber, there should be a macro prudential policies. Let's say sovereign welfare fund can be, but it differs from country to country. So is there any shocks, especially the main important thing is that fiscal stance. So the fiscal stance or consolidation, that can be on policy. Another policy can be sovereign welfare fund to absorb any kind of a shocks, to stabilize balance of payment, exchange rate.
Yeah, but like the fact that the exchange rate will appreciate, it's a well-established fact, right? So we all know it, right? Yeah. So like, where is the contribution?
Okay, so
and how do you account?
I understand. So there is some short-run policies and long-run policies. For the long-run policies, for instance, UAE or Qatar, they reduce significantly they decouple these shocks from the oil market in their economy. So through the diversification. So let's say UAE, they have a service sector is playing a big role, contributing in overall GDP, right? At the same time, like Saudi Arabia, they have a policies like NEOM project or Gidea project or Red Sea project. They have so many plans for diversification of the economy. But I'm sure that this will help in long run. But the short-term absorber only, you should have some kind of a macroprudential policy like the sovereign welfare fund to reduce the shocks, so stabilize the market. That's all. But in short run, of course, the policy is just, you have to stabilize the market from some kind of a fund. But in long run, the only policy is the diversification to decouple the shocks.
Thank you. Any other questions? I guess no. So we can switch to our second paper, and they will be presenting online. Let me check. So the presenters are Talha Yalta and Yasemin Yalta. They will be talking about the effects of financial inclusion on the economic development in MENA countries. So the floor is yours, Yasemin Hocam.
Hello. I'm gonna start screen sharing first. Hello, my name is Yasemin Yalta. I will be presenting our paper titled The Effects of Financial Inclusion on the Economic Growth of MENA Countries. I'm from Hacettepe University, although today I will be joining from New York. That's why I have to log in online. Financial inclusion is defined as access to financial products, and we know that financial inclusion is very important, especially for developing countries, because it makes it possible for us also to obtain necessary capital to undertake new investments. And it also provides funds for emergency situations and facilitates the pooling of financial resources. There is also evidence in the literature suggesting that financial inclusion is positively related with economic growth and negatively related with income inequality. Therefore, it is important to understand the relation between financial inclusion and economic growth. In theory, the causal relationship between financial inclusion and GDP can run in either direction. First of all, according to finance-led growth hypothesis, financial inclusion can stimulate growth by increasing capital accumulation. On the other hand, an increase in GDP can increase access to financial services and lead to higher financial inclusion. And of course, there can be a two-way relation between financial inclusion and economic growth. Although there have been several studies on the relation between financial inclusion and economic growth, the evidence so far has been mixed. For example, Sharma finds that number of deposits and loan accounts increase economic growth in India. Sethi and Acharya finds a bidirectional causality between financial inclusion and economic growth for a set of countries. Similarly, Singh and Stakik finds a bidirectional causality between financial inclusion and economic growth, again for a panel of countries. Despite its importance, there are only few papers examining the link between financial inclusion and economic growth in MENA countries. One of these studies is by Emara and Elsayed. In order to calculate or define financial inclusion, they use the number of bank accounts for corporates, and the number of bank branches. And they find that financial inclusion is positively associated with GDP growth rates. Jones uses a similar measure. In that study, number of ATMs, number of depositors, number of borrowers are used for financial inclusion. And it is found that financial inclusion has a positive effect on GDP. When we review the existing literature, we see that the majority of the studies use certain financial inclusion indicators, such as the number of bank branches, number of ATMs. However, financial inclusion is a broader concept. It has several dimensions and it has subcategories. Therefore, we need to analyze the relation between these different dimensions and economic growth. Therefore, we offer two contributions. First of all, we analyze the causal relation between multiple indicators of financial inclusion and economic growth, so that we can assess which aspects matter the most, and we can offer policy recommendations based on these findings. While analyzing different dimensions, the effects of different dimensions, we focus especially on the causal effects of the number of bank accounts and barriers to financial inclusion, as well as digital finance. Our second contribution is the methodology we adopt. We adopt a recently developed nonlinear and non-parametric kernel causality approach. I said that the majority of the studies use certain indicators of financial inclusion. It is because of data limitations. And we know that in order to undertake a causality analysis with granular causality tests, we need a long time series data. However, with kernel causality approach, it is possible to explore causal relations with cross-sectional data. And in this study, we are going to undertake this kernel causality approach. This approach is a useful guide for policymakers to make decisions when analyzing the causal relation between two variables. In terms of data, we are going to rely on the global Findex database. This is a unique database published in 3 years. So we have data for 2011, 14, 17, and 21. It measures the use of financial services, including both demand and supply factors. In this data set, there is information on account numbers, on mode of access, barriers to account use, and alternatives to formal accounts. And all of these are also provided on the subcategories of gender, age, and income levels. Because it has several subcategories, in order to make analysis easier, we focus on 3 main categories: account numbers, digital financial inclusion, and barriers to financial inclusion. We use data for 20 MENA countries, including Turkey and Iran. We use purchasing power parity adjusted GDP in constant dollars obtained from World Bank. To examine the relation between financial inclusion and economic growth, we adopt kernel causality approach, which is also called instantaneous causality. It states that a variable x instantaneously causes variable y if the present value of y is better predicted when the present value of x is included in the prediction. We not proposed a method to implement kernel causality by adopting the concept of generalized measure of correlation developed by Zeng. So in this method, we actually compare the coefficient of determinations obtained from two-way kernel regressions. Kernel causality approach is based on the following two regressions. And for the non-parametric Nadaraya-Watson regressions, we calculate the coefficient of determination as follows. Then we calculate the sine square root of R square and obtain the generalized measure of correlation between xy and between yx. Then we calculate the difference between two population R square values, and we denote this by delta. Therefore, it will be R measure. And based on the previous equation, kernel causality is defined as follows. If delta is positive, it means that y kernel causes x. If delta is equal to 0, kernel causality is bidirectional. If delta is positive, x kernel causes y. To test the statistical significance of delta, we employ the modified t-test by V naught. So if the test result is significant, it means that there is one-way causality from x to y or y to x, depending on the value of delta. The preliminary analysis begins with using Pearson correlation test, but we know that a statistically significant Pearson correlation does not reveal the direction of causality, so we continue with kernel causality to identify the direction of causality. Here I will present the results in three main headings. First of all, I will talk about the causal paths between account numbers and GDP. This is a long table, so I divide it into two. In the first two columns, we see generalized measure of correlation. In the third column, we see delta. And we see the causal relation in the last column. So when we look at this table, we see that the share of women who has an account kernel causes GDP. Similarly, the share of adults having an account with primary education kernel causes GDP as well. In terms of share of male adults having an account, causality runs from GDP to financial inclusion. When causality path is investigated between different income groups and GDP, we see that there is a two-way relation. The results are the same when we consider financial institution accounts. Again, we see that the share of women who has an account kernel causes GDP. Secondly, we examine the causal paths between digital financial inclusion and GDP. In this category, we analyze digital payments made. Again, there are different indicators, and each indicator has subcategories in terms of age, gender, and income. You see that having a mobile money account kernel causes GDP, as we see in the first row. And the causality runs from the share of female having a mobile money account to GDP. The share of adults having a mobile account with primary education also kernel causes GDP. Thirdly, again, here we see the relation between different types of digital payments and economic growth. Thirdly, we analyze the causal paths between barriers to financial inclusion and GDP. In the literature, different barriers have been emphasized, such as affordability, physical distance, lack of necessary documentation, having insufficient funds, religious reasons. And we see those barriers in this table. And we see that having no account is related with economic growth. In some countries, people do not open accounts because they think that financial services are too expensive. And we see that it affects GDP. And here we see that some people do not have accounts because they have insufficient funds. And we see that there is a causal relation between this indicator and economic growth as well. When we review these empirical results, we see that not all indicators of financial inclusion have a significant effect on GDP. Certain indicators have a greater effect. We see that gender gap is an important factor because the share of women having a formal account kernel causes GDP. Furthermore, the share of adults having an account with primary education positively affects GDP. So here we emphasize the role of primary education. When the causality path is investigated between different income groups and GDP, there exists a two-way relation. We also see the importance of digital finance in these empirical results because having a mobile money account and the share of adults having a mobile account with primary education are also positively related with GDP. There also exists a bidirectional causality between various indicators of digital financial inclusion and GDP growth. These empirical findings provide important policy implications. For example, reducing gender gap in financial services should be one of the priorities to increase financial inclusion. Promoting better education policies, increasing financial literacy, enhancing access to digital technologies, reducing the fees on certain financial services and making them more available are also important policies. And of course, in order to reduce the fees, competition should be encouraged in the banking system towards achieving lower fees. this is a work in progress. Therefore, we plan to proceed in two ways. First of all, we plan to update the data. Global Financial Index database is updated. So we will include this recent data in the analysis. We also plan to extend country coverage. We plan to include more countries from other regions in order to better evaluate different causal relationships between financial inclusion and economic growth in different regions, and maybe compare different regions in terms of these causal relationships. Thank you for listening. I'll be happy to hear your suggestions, questions.
Thank you, Yasemin Hocam. Okay, so thank you, Yasemin Hocam. It is a really interesting paper. The aim, there are many studies, even in MENA countries, that investigate relationship between financial inclusion and the growth. But this paper adds to this, and it's also look at the direction of the causality between the GDP and the financial inclusion. While doing it employs a newly generated approach. It is the kernel causality approach, and they use global Findex database for the analysis. And their main finding can be summarized like this: an increase in the share of women having bank accounts, the share of adults with primary education having an account, as well as the share of adults having a mobile account lead to an increase in GDP. They also check for the barriers, and they find that affordability and having insufficient funds are also associated with GDP growth. Well, my first comment is based on the data. So I think the data section needs to be more clarified. I could not catch whether, so we see that there are 3 waves of the database, but I cannot see whether we are employing the last one or we are just pooling the 3 waves. It's not clear, but I think important part is that, so if we are just employing the last version of the survey, it means that we are only using 20 countries cross-sectional data. So which means that in the analysis we have 20 observations. I'm not familiar with kernel causality, but 20 observations, I think in the econometric framework, it's really a low number of observations. My main concern is representativeness. So we have, on the one hand, a GDP data. It's a macro variable. On the other side, we have a survey data, okay? And using the answers to this survey, the index created a macro variable on the country level, okay? So based on the individual responses, we are creating a, let's say, number of account having people in the country. But since we are trying to connect these macro variable GDP and this, in a way, micro variable, we need to be careful whether this survey is representative, okay? So if it is not representative, then we just come up with a number that the share of the adults who are having an account is that much, but if it is not representative, then we are catching in a way, not a proper relationship. So in this respect, we can check the survey results with some country numbers, whether they have, for instance, in Turkey, we have the number of people who has accounts. So we can just compare the survey and the country, national country numbers to prove that our data is representative. And it's also more important for the subgroup analysis by gender, education, and income. You know, when we divide the sample, we don't know whether the sample is representative for these subgroups as well. For the data section, a descriptive statistic table would be super useful. We can, in a way, understand which country is doing how in terms of these indicators. While reporting the results, I see that in tables 2 and 3, not in 1, there are the quotation of indeterminate results. So why do we have those results? It's not clear to me. Okay, why do the model fails to give results for these variables? While doing the subgroup analysis, the education is divided only 2 groups. The first group is primary and less. The second group is secondary and more. So, but if we can add more education groups, the result, I mean, at least policy implications could be easier. So why do not we have high school or college graduates separately in the data? It's not clear. Also, this part is not clear to me. So why do we run Pearson's correlation test first? Okay, I see the idea. We need to understand whether there is a relationship between the variables. But if Pearson says no, in the table we see some still kernel findings there, okay? Then why are we running kernel density, kernel causality estimates for these variables that have no correlation at the first stage? So, and I wonder whether this kernel causality test says anything, whether the direction, okay, it says the direction, but whether there exists any relationship between the variables or not. Okay, so we only trust in Pearson's correlation test here. In the conclusion part, there is a sentence, and it says that the results suggest that the share of account with primary education positively affects GDP as well. Therefore, attempts to reduce gender gap in financial services and improving educational level should be a priority. So, we find the relationship for the lowest education group, primary and less, the guys who do not have any education. So based on these findings, I think so it's not normal to say that the primary education has a positive effect, so increasing education is a policy option. So based on these findings, we cannot, I think so, propose that increasing education is a policy option because we are finding a significant result for the lowest education group. Okay, so the policy option could be that, okay, increase the number of individuals with primary and low education group. And this is a very minor comment. Some of the cited articles do not take place in the references, at least in the version that I have. These are my comments, Yasemin Hocam. Now we can have some additional comments from the floor, and you can answer, if you want, all of them together. So, any comments from the floor? Any questions? No? Okay. Okay, so these are the comments, Yasemin Hocam. If you want, you can just answer. Otherwise, we can move to the third presentation. Can we see her in the screen?
Thank you for your comments and suggestions. First, regarding your first question, we didn't only use the last year's data, we used all 3 years' data, so we have more observations, not only 20 years. But one advantage of kernel causality is that even if the number of observations is low, we can still use it. It is why we chose this method. It is one benefit of this method over the previous ones. It's a good suggestion to compare data from surveys and country level data. We can do this in the revised version. Subgroup analysis based on gender, education, and income can also be undertaken. We already see these in the results. They are already there, so more analysis can be done on these. Global Financial Index database provides education in terms of primary, secondary, and more. They don't provide information on high school or college education. That's why we had to rely on this data and couldn't separate in terms of high school and college education. We listed Pearson correlation coefficient on the paper because it is one of the main analysis we use in economics just to give an idea. But even if there is no correlation, we can use kernel causality. Thank you again for suggestions. We will definitely consider these in the revised versions.
Thank you, Yasemin Hocam. So now we can move to our third presentation. Reem, or who is going to present? Reem? Okay, so Reem is going to present their study on a recently adopted macroprudential policy on Tunisian economy using a DSGE model.
Hello, my name is Reem. I'm going to present the bank leverage cycle and external finance premium in Tunisia, a DSGE model approach with my co-authors, Professor Nabi, Professor Nabi and Mahmoud Nabi and Houda Boubaker. Okay. I'm going to start with introduction, then the importance of financial accelerator, the DSGE models, and the framework of GK or BBG models, monetary policy implication, and finally I'm going to conclude with conclusion. So, I'm sorry, just okay, thank you. So, an introduction. Most really economics presume, before 2008, that the macroeconomic models work smooth enough without introducing the financial sector in modeling macroeconomics. That happened, of course, before 2008 crisis. And in 2008, the size of subprime mortgage is really about less than 0.5% of the financial system. However, the result and the impact of that shock was huge, not only in United States aggregate macroeconomic variables, but worldwide. That's why most researchers have focused on the concept of the financial accelerator effect after 2008. Mostly, not only after 2008. There's some few papers before, to be honest. But the term, what is the financial accelerator effect? It's used to reflect the amplification, propagation of shocks mechanism and their mechanism. It's aimed to explain relatively how small economic shock can have larger persistent effect in aggregate demand, aggregate economic activity to the financial friction. As you can see the picture, our snowball effect, they call it the financial accelerator or snowball effect. The importance of the financial accelerator, why is really important to have this, to include this concept in modeling? The modeling approach reflects the various participants' attitude toward whether they can overcome a problem of asymmetric information. In this example, I took a relationship between borrower and lender, and this is one of many types of source of asymmetric information. The asymmetric information, it's a problem can emerge because borrower intention on honesty is hidden or not known by the others or the lender before transaction take place. So if there is a friction, what's going to happen? So a change in aggregate demand activity will have a negative correlation on change on economic Asian network. So that will have a positive correlation and change in external finance premium and then change in investment and spending production. And this circle goes on and on and on. Now we see we're gonna see the models that we used, the model that we used to model our concept, the dynamic stochastic general equilibrium. Whereas these models, we call it's dynamic, of course, in time, stochastic because Asian knows only the distribution of previous shocks. It's linearized using Taylor formula. The first order agent behave the future shocks equal to 0. And finally, it's a sum of individual choice and decision made by firm, households, and government. And here in these kind of models, we include the financial sector. So to introduce financial sector in DSGE model, there is kind of family of DSGE models. Though the first, I'm gonna give like few famous families. The families of we saw from the supply side of banking sector, and then the demand side of banking sector. The supply side we have Yalta and Garadi approach, which is financial accelerator effect, emerge to asymmetric information of the problem that constrained the ability of bank to obtain funds from depositor. And this concept really starts after the crisis, to model the crisis properly. The supply side, the demand side. The demand side, this began a little bit earlier. You can see late 80s, early 90s. All of them focus on the relationship between the banks and borrowers. The most famous one we call the BBG, the Bernanke and Gelter and Karad approach and their idea implement between economic engine network and external finance. So this is the type of friction they modeled in this model. The other one, the source of asymmetric information, an equity market, asymmetric information equity market, and the manager risk aversion attitude. The third one, which is Kiyotaki and more, which considers informal asymmetric information and credit market and the cause of financial accelerator effect, not to be able to enforce debt payment. So there is an abbreviation for all these models. The first one, we call it the JK, and the first one on this side, we call the BBG. As you can see, these two type of model the supply side of how obtaining loans from the banking perspective and the demand side of how banks give loans to borrower. And you can see the DSGE model all these like components, that the banking sector relationship with banks, the households, the production functions, and the retail, all these relationships with equation, and we do like dynamic optimization of this, all these preferences, let's say. So in our model, we're gonna focus on both loan supply and demand through the concept of financial accelerator effect, which is asymmetric information. So when I say GK is the model of Gelter Karadi and BBG, the mother of like the model of supply, and the BBG, the model of demand. So now I'm gonna a little bit detail on these two models. Our model, we're gonna consist on combining both these friction and only one. So a medium-scale Keynesian model, composition of firm goods, household preference, consumption household are the same, and Smith-Root source, and start with DSG, any kind of DSG model. And we have the glass function, prices, wages, thickness, and stage. Price setting, the nominal interest rate, the central bank form, say, parole. So usually when we choose the DSG model and we try to question one feature, we try to simplify other features that are not necessarily related to our question. So that's because if you put more characteristics, you can put more characteristics if you want. But for more like precision, you can use 3 or 4 different models to answer the same question, and each time to change one feature is better. So simplify the other ones and focus on one specific feature. That's the technique that we use. So again, the friction between the bank and depositor, which is the supply side, the JK model. You can see here by equations. So I simplify, I put only necessary one, there is more. I have the loans from both. It's like less riskier or riskier. Loan side, they accumulate wealth. The bank have finite life, which is just a mathematic maximization. Maximization. It works in English. Okay. Our model has a problem. There is for the supply side, the bank can steal friction. Okay, I'm gonna talk about this one. This is important. This specific features developed by Garadi, and he say like this, he modeled this concept. The depositor cannot trust the banker. They cannot put their money in banks. And this feature is modeled in the United States. Okay, why I choose this specific one to apply it in Tunisia? The reason of here they not trust their banker because they fear that after a certain amount, maybe the banker will steal the money from the bank and go with it. However, if you see in Europe and United States, this doesn't happen often. So they criticize him a little bit, but put in this hypothesis. However, they did the survey. There is an article of, I don't remember his name, but he worked in Germany, Central Bank of Germany, and he did a survey of the central bank worldwide, not only central bank, big banks, and they asked him this specific question. If of a certain amount of money, would you steal it? And this is anonymous. And the answer, yes. If the bank is so high, the banker might consider of stealing. But this is not applicable, but it does exist. In Tunisian case, so this is a hypothesis that put condition on banks to obtain, not able to obtain amount of deposit from households, okay? The source here, not trusting the bank, okay? In Tunisia, we don't have the concept of not trusting exist direct. We don't, as a culture thing, we don't put our money in bank. So even though it doesn't necessarily, they fear of the banker steal the money, but they don't put the money in bank anyway. It's a culture, especially in the south of Tunisia and the west of Tunisia, they don't put. So this specific feature is like the plus here in this model. I will continue now. So this is optimization of the banking problem. So I just explain, we put equation and optimize them, all of them, okay? Now we go to the other side of when bank give the money to borrowers. The BBG, the side of demand. The friction between banks and borrower. The interpreter here balance sheet and the specification characterization of this model, and they're interpreted by unit of capital and here distribution, and describe the cross-sectional section, aggregate return on capital, as simple as possible, but I put a feature that the bank take responsibility when the project is lost. So this feature is not really implied all the time, and this I put this characteristics to highlight not the banker not really willing to give much or take the risk to give to borrowers because they will bear the loss. So this will be equation number 3 here to give the difference between this. So now we go. Other features that included in this model that specify the Tunisian case. We have other challenges in our economy. So in addition, the first one that we talked about later is the household reduced to save their money in banks. They do not like it, to put it culturally perspective. And the entrepreneur borrowing cost depends on the leverage. And this is really, so the banker tend to not give to borrowers as investor they tend to be given as a consumption loan than investment. And also, this is important, 40% of the bank loans cover the government budget deficit. Even when you have the loan, 40% go to the government. And the fourth one, the bank capacity to gain credit by constant new macroprudential policy. We have here this ratio. We have this, so like imagine the situation that the banks, they cannot contain enough deposit from the household. Also, macroprudential policy, they have a ratio, they cannot give certain amount of loans, even in general. So it's like balance sheet is tightened from both sides. So this is the resources of the condition that I put on more details. So I can skip this to give more. So the result is, as you can see here, the comparison between the full model, the BGG, GK, and non-fractional model. And this is monetary policy implication, the condition of tightening of. So you can see the GDP in full model, there is the lowest one regardless to other models. Also, I'm going to talk about investment, that also this is the lowest one. And this result is this model capture, if you tighten on both sides, that will affect the investment highly, and as a consequence, that will affect GDP. And that would happen in our country. Exactly. So as you compare, the other one doesn't feature the same thing. And I focus on only one thing. As I said, if you choose DSGE model, focus in specific way. So as you can see, just for anyone who starts in DSGE model, and everything, so for example, inflation is almost the same, okay? Almost, not the same. Because I'm not focusing on inflation in my question, so I don't put fish, I simplify other questions. So I'm focusing on loans, because that's the relationship of banks, and affecting investment. So investment and GDP, I focus on that. Good? So I here just explain decline in investment, and then we found that at the friction. So plus in our work is DSGE model is usually applied in developed countries, United States, in Europe. Last few years they trying to apply it in our countries like emerging economy, and now they want to see what kind of feature that will capture this type of models. So you have to be specific when you use this type of models. In our specific case, we try to describe the economic situation as much possible and use this model for money and for policy money implication. So we combine both fraction, we describe more and more reality. So I just said the result. So full model experience. I'm starting checking if forgetting something. Description of monetary policy. No, that's it. So that's it. Important is that the credit friction that are important for conduction monetary policy. Credit friction means the both sides of having money and given money. That really important to include it in implementing monetary policy. The not ability of Tunisian given money to banks, that should be modeled and taken into consideration. Thank you.
Okay, so thank you. It's a really nice presentation, and it's a really good paper. So I haven't been studying theory for a long period of time, so I have to recall my knowledge from many years ago. So my comments are maybe not that good, but sorry about it. Okay. So the aim of the study is to explore the impacts of monetary policy changes on credit demand and supply and their implications in Tunisia using a DSGE model. And they particularly focus on the financial accelerator effects. And the paper uses a standard medium scale NK model with two main financial frictions established in the literature. The first one is on the demand side, friction between bank and depositor, and the second one is on the supply side, it's the friction between bank and the borrower. Okay? And their main contribution is assessing the impact of a recent macroprudential policy implemented by Central Bank of Tunisia in 2017. It is the loans to deposit ratio. And the model tries to capture, as we mentioned, four stylized facts. Okay, the first one is households' reluctance to save their money in the bank. The second one is entrepreneurs' borrowing cost depends on their leverage. And the third one is 40% of the bank's loans cover the government budgetary deficit. And the last one is the bank's capacity to grant credit is constrained by this macroprudential measure. This is credit deposit ratio. It is introduced by Central Bank of Tunisia. Okay. My version was incomplete, the paper, so it is, in addition to that, I am not focusing on theory for a long period of time. It was incomplete, so it is really hard for me to discuss the paper, okay? So my first comment is, following the creation of the model, the authors employ a Bayesian time series method, right? So in this respect, there is no discussion how the priors were selected. So it will be useful to discuss how they are chosen. And moreover, deep parameters are borrowed from, I think so, as far as I understand, they are borrowed from other general equilibrium models. And I don't know whether they are appropriate for Tunisian economy, suitable for Tunisian economy or not. Okay, so I cannot see it at least. In addition, there is no information how the steady state values were calculated. They used the historical averages or some other methods, so it will be useful, at least my version was incomplete as I mentioned. It will be useful to mention it in the full paper. In the policy implications section, it is stated that full model is expected to produce a more realistic investigation of the financial sector. So, okay, but we need to give a proof for this, how we know that it's better. So we don't know anything, adding these frictions better explains the characteristics of Tunisian economy or not. So maybe we can discuss it in the paper. On the other hand, I think so it will be useful to provide some insights using some empirical model like VAR model. Okay, so in this respect, we can see how our model coincides with the findings of an empirical model. So it could be useful to employ a VR type of estimation. And these are my last suggestions. I know it is hard, but in your model, economy is closed, right? But it will be, I think so, interesting to use a small open economy version of the model, okay? Because we are focusing on a macroprudential policy, so using a small open economy version could be more interesting. And maybe you can extend the model of Garcia-Kiko and Kirchner 2016 paper, and it employs a small open economy with two financial frictions. Okay, so you can extend this. And if you do this, there could be some interesting findings. So you can incorporate your results using deposit dollarization and credit dollarization. Okay, if you use the open economy model. And since the new policy is directly related to impact of regulatory changes on the usage of domestic credits, the dollarization issue could be interesting and I think so catchy. You can use it, so you can answer at least some interesting questions like what will be the impact on dollar-denominated loans? What will be the magnitude of financial acceleration under different dollarization rates? And which alternative macroprudential policies could be useful and worth analyzing in this setting? Okay, so if you switch to an open economy, maybe you can answer these questions. So it's really good paper. Thank you. Now we can open the floor for questions. Please go ahead. It may be close.
Okay, thank you for the presentation. I just have one clarification question and a suggestion. So for the suggestion, I think it will be important just to better motivate and explain the rationale behind the simulations, to explain the transmission mechanisms of monetary policy in Tunisia. Just from a conceptual framework, to what extent the interest rate channel, the monetary institution channel, the exchange rate channel, the balance sheet channel, and so on behave, in order to show to what extent the results of the simulation make sense. And then I was wondering also, I haven't read the paper, but I work more on CGE models, not on DSGE models, and in general to test for the robustness of the results, we changed the values of the main parameters. So I don't know whether you did that in the model, and how you chose the alternative measures of the parameters in order to test the sensitivity of the results. Thank you.
Thank you. Another one? Any other comments? Go ahead.
Okay, so I'm just wondering that you mentioned in your presentation that during the financial crisis, there's a spillover effect, many countries suffered. So through the international monetary arbitra or monetary connectivity or integration, so whether a country-specific model can absorb or can capture this kind of a shock from other countries, like from the trading partners of Tunisia, like the way global VAR model can capture this effect, whether DSG model can do that.
Thank you. Any other comments, questions? I think so. That's all. Reem, if you want, you can answer.
Like I said, DSG models are like any models. You can ask a question. If I have a specific feature, you can present it in type of a question. If you are working, for example, in China, and you have to effect of United States trade or something in China, you put it and you will go. So it's widely used and widely families. They called by families. So for the parameters, this for both, and the other one asked me, this is like the last paper of 3 other papers. The work in GK by itself and BBG by itself with Bayesian estimation, and the parameters are based in some work of Tunisian and international of some. So there are Bayesian estimation of those parameters. But this full model, if you put 2 friction, that becomes so heavy. This model is calibrated based on the previous work. Okay, this is my 3rd paper in PhD. So the first one, GK by itself, Bayesian estimation. I discussed the parameters there, and as a result, but this I cannot do Bayesian, because I said if you put too much information with a little bit of data, they're gonna give you mad sense. So this calibrated based on 2 words. Monetary policy, yeah, that's chapter. Yeah, of course, monetary policy. So if you're gonna focus, I highlighted in this little bit presentation why I choose the friction of the Tunisian not putting their money in bank, and how that affect monetary policy. So monetary is the result, is not the goal. The goal is the election. You should, when you describe something, you have so much feature, and this feature was so neglected. So yeah, monetary policy, it is a chapter to talk about in my PhD, and then the result, how can really put it in a better way. So open economy, yeah, again, open economy, it should be a trend here. But in Tunisia, the relationship between banks, deposit, and investment in Tunisia is not that related to dollar. So yeah, it should be how we are small economy, small open economy, Tunisian. But again, I think I didn't apply it. If you apply a small open economy model, and the result is not going to be different because our investment in Tunisia is not related at all. Okay, but it's the same. And then I thank you. Other question? No. Thank you. Thank you.
So we can end this session. So it was great. I would like to thank all the participants and audience one more time. So thank you, guys.